Stock Market for Beginners 2024 Step-by-Step Guide. So before we get started, make sure to hit that like button, also subscribe to my channel. What is the stock market? Stocks, which are also called equities, are securities that give shareholders an ownership interest in a public company. It's a real stake in the business, and if you own a majority of the shares of the business, you control how the business operates. The stock market refers to the collection of stocks that can be bought and sold by the general public on a variety of different exchanges. Where does stock come from? Public companies issue stock so that they can fund their businesses. Investors who think the business will prosper in the future buy those stock issues. The shareholders get any dividends plus any appreciation in the price of the shares. They can also watch their investment shrink or disappear entirely if the company runs out of money. The stock market is really a kind of aftermarket, where people who own shares in the company can sell them to investors who want to buy them. This trading takes place on a stock exchange, such as the New York Stock Exchange or the Nasdaq. In years past, traders used to go to a physical location, the exchange's floor, to trade, but now virtually all trading takes place electronically. When news people say, the market was up today, typically they are referring to the performance of the Standard & Poor's 500 or the Dow Jones Industrial Average. The S&P 500 is made up of around 500 large publicly traded companies in the US, while the Dow includes 30 large companies. These track the performance of the collections of stock and show how they fared on that day of trading and over time. Buy the right investment. Performed well in the past, but anticipating the performance of a stock in the future is much more difficult. If you want to succeed by investing in individual stocks, you have to be prepared to do a lot of work to analyze a company and manage the investment. When you start looking at statistics, you've got to remember that the professionals are looking at each and every one of those companies with much more rigor than you can probably do as an individual, so it's a very difficult game for the individual to win over time. CFP, Chief Financial Planning Strategist at TIAA. Avoid individual stocks if you're a beginner. What they forget about is that often they're not talking about those particular investments that they also own that did very, very poorly over time. So sometimes people have an unrealistic expectation about the kind of returns that they can make in the stock market. And sometimes they confuse luck with skill. You can get lucky sometimes picking an individual stock. It's hard to be lucky over time and avoid those big downturns also. Remember, to make money consistently in individual stocks, you need to know something that the forward-looking market isn't already pricing into the stock price. Keep in mind that for every seller in the market, there's a buyer for those same shares who's equally sure they will profit. Create a diversified portfolio. One of the key advantages of an index fund is that you immediately have a range of stocks in the fund. For example, if you own a broadly diversified fund based on the S&P 500, you'll own stocks in hundreds of companies across many different industries. But you could also buy a narrowly diversified fund focused on one or two industries. Diversification is important because it reduces the risk of any one stock in the portfolio hurting the overall performance very much, and that actually improves your overall returns. In contrast, if you're buying only one individual stock, you really do have all your eggs in one basket. Be prepared for a downturn. The hardest issue for most investors is stomaching a loss in their investments. And because the stock market can fluctuate, you will have losses occur from time to time. You'll have to steel yourself to handle these losses, or you'll be apt to buy high and sell low during a panic. As long as you diversify your portfolio, any single stock that you own shouldn't have too much of an impact on your overall return. If it does, buying individual stocks might not be the right choice for you. Even index funds will fluctuate, so you can't get rid of all of your risk, try how you might. One of the interesting things is people will see the market's volatile because the market's going down, of course. When it's going up, it's also volatile, at least from a statistical standpoint, it's moving all over the place. So it's important for people to say that the volatility that they're seeing on the upside, they'll also see on the downside. Try a stock market simulator before investing real money. One way to enter the world of investing without taking risk is to use a stock simulator. Using an online trading account with virtual dollars won't put your real money at risk. You'll also be able to determine how you would react if this really were your money that you gained or lost. That can be really helpful because it can help people overcome the belief that they're smarter than the market, that they can always pick the best stocks, always buy and sell in the market at the right time. If their thought is that they're going to somehow outperform the market, pick all the best stocks, maybe it's a good idea to try some type of simulator. Or watch some stocks and see if you could actually do it. Then if you're more serious about investing over time, then I think you're much better off, almost all of us, including myself, to have a diversified portfolio such as provided by mutual funds or exchange-traded funds. Avoid short-term trading. Understanding whether you're investing for the long-term future or the short term can also help determine your strategy, and whether you should be investing at all. Sometimes short-term investors can have unrealistic expectations about growing their money. And research shows that most short-term investors, such as day traders, lose money. You're competing against high-powered investors and well-programmed computers that may better understand the market. New investors need to be aware that buying and selling stocks frequently can get expensive. It can create taxes and other fees, even if a broker's headline trading commission is zero. Depending on your financial goals, a savings account, money market account or a short-term CD may be better options for short-term money. Experts often advise investors that they should invest in the stock market only if they can keep the money invested for at least 3 to 5 years. What do you think about our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.